Morning and welcome to FXPRIMUS. Today guys, we're going to go over news trades such as non-farm payrolls, which as you all know is a huge event on the economic calendar for any trader. Now these webinars, for those of you who don't know, are all recorded. Offer a simple and easy understanding of material required and skills required to trade for yourself successfully in the markets. Okay, just before we get started, I'm just going to and past performance does not guarantee future results, so please never risk money you cannot afford to lose. Okay, so as I said, today we're going to have a look at news trades. Some of you have great trade plans which initially work out quite well, and then suddenly halfway through the trade everything falls apart, and quite often you discover later that it's a result of a news announcement, perhaps something you didn't realize was going to be announced. Perhaps you didn't look at the economic calendar. So it's the that's the kind of pitfall that we want to avoid when trading. For those of you who have not been to any of my webinars before, I want to welcome you. Thank you for attending. My name is Peter Petru. I'm a full-time trader, FX market strategist, and guest speaker here at FXPRIMUS. Now, I do these webinars every Monday and Thursday, and I hope to share many of my experiences with you in the hope that it helps your trading, helps areas of your trading, your technical analysis, your fundamental analysis, and of course I'm available for any questions you may have, any queries you may have regarding not just what I'm going to cover in today's webinar, but perhaps something that you've seen in a previous recorded webinar, or just anything you have, any queries you may have really about any of the markets. Perhaps there's something you're hoping to improve in your own trading, and you just would like some help. Feel free to let me know on the in the questions or chat box, and I'll do my very best to answer wherever I can. Okay, so news trades. As I said before, just simply knowing technical analysis is not going to be enough. Is not going to be enough to help you avoid sudden moves in the markets which are driven by news events. Everyone should have an economic calendar available. You've got one there on the FXPRIMUS website, and you should make use of that calendar. You should know throughout the day when you're trading what news is coming out, so you can then work out how that announcement could affect your trade one way or the other. Because remember, these announcements, these fundamental forces are what drive movements in the currency markets. So when are these announcements made? Well, all of these announcements are the scheduled announcements anyway, are available on an economic calendar. So have one of those up. Now, you are going to get news announcements, shock announcements that you're not going to be on the economic calendar. There is nothing really we can do about that. We can't foresee the future insofar as if a war is going to break out, or 9/11 was an example of something that you wouldn't have seen and been able to prepare for. However, there are many economic announcements that occur every day for different countries, and these are available, and we can look forward to them, look forward to planning and managing our risk around them. Now, some of you may think, well, why should I trade the news? Is very risky. It does carry a high degree of risk because the announcement is not known to anyone. So the news comes out and you have a huge reaction, like you can see here on the chart on the right hand side. This is a news reaction. Yeah, so this is the normal market. Something's going on, then we've had a reaction because some news has come out here, and you can see a drastic change in price in comparison to what was happening beforehand. Now, I'm not saying you should trade the news. You can completely ignore all news events and don't trade them. But I would say it would be a shame. I mean, it's certainly not my the core of my trading, and it's not the bulk of my trading. However, we are aware of when these news announcements are going to be released, and if you're someone who's going to be at the charts, I don't see any reason why you shouldn't train and practice and learn how to take advantage of these news events and how to make money from them. Passing up an opportunity which happens almost every day and every week. It's entirely your decision, but if it is something you do want to perhaps look at adding to your repertoire of tools and tactics, then this is the webinar for you, and I'll discuss how we can trade these economic and news announcements. And before I go on, I do want to mention though that during these particularly the important news announcements, you do have a it's very likely you'll have high volatility, and with high volatility comes wider spreads if you're trading on spreads, and slippage, and you guys know what slippage means. So bear that in mind, that obviously the trading environment is very different during a news event than it is throughout the other periods of the day. What is important is that you have a plan in place, so you know what you're going to do beforehand, and it gives you that element of control, because you have no control over the market, but you should have control over your own actions. So before we go on and talk about a strategy and tactics of how to trade the news conservatively, I know a lot of you are going to ask, well, which news releases which ones should I trade and which ones should I ignore. Now, the way I do this, let's go back a step. When we're looking at an economy, certain things are important that could be important this year, depending on what we're looking for in that economy. You may find that certain economic announcements this year are very, very important, whereas perhaps next year they're not so important. Now, what do I mean by that? Let me give you an example. Let's say we're looking at the US at the moment, as we are, and a lot of traders have priced in a number of interest rate rises this year and bought the dollar up and built positions on that basis. Now, when Janet Yellen says anything to suggest otherwise, or when there's any kind of economic data which isn't extremely good, which would support the idea of and the need for various interest rate rises in America, that would be looked at as very negatively. Yeah, so we're very sensitive at the moment to slightly less than better than expected unemployment figures or inflation, things like that. Whereas, let's say the yen will not be as sensitive to this information because the expectation is not, we have a different expectation for the Japanese economy. So you see, it's not as simple as saying, oh, only follow this particular economic announcement or that economic announcement. You have to understand the economy, and you have to understand for now which economic indicators are more important and the market is more sensitive to their releases. And as time goes on, this will evolve and change, and we'll be more interested in other economic indicators. Another very good exercise I often do, and I would suggest, is to Google and look at the average pips moved for particular news events. So, for example, something like non-farm payrolls, I would say, is probably the most important news event on the economic calendar. Yeah, I mean, it's right up there with an interest rate decision. So when is non-farm payrolls released? Anyone know? I assume you all know what non-farm payrolls are. Yeah? Yeah. We have payroll data from the United States, which is released, and of that payroll data, the non-farm payroll data, which represents the total number of people which are in America who work and are paid, but it does not include government employees. It doesn't include charity organizations. It doesn't include private household employees. Yeah. So that is a very, very important economic announcement. And of course, as the name suggests, farm workers, it won't include those. This is released every month, yeah, first Friday of the month by the US Department of Labor, and it's eagerly awaited by traders all over the world. And the reason we look at the non-farm as opposed to the whole figure is because obviously you have the seasonality in farm jobs, and so for our intents and purposes, it's best if we separate that seasonality out when we look at the job figures, so we can have a more accurate reflection on the the employment, the payroll employment. So this is released on the first Friday of the month at 8:30 a.m. Eastern time, New York time, which is for me over here in the UK is 1:30 in the afternoon, 1:30 GMT. So now the non-farm payroll, as I said earlier, it's a good idea, and I would advise you to have a look at this and do some research online and get the average pips. The average pips moved for a news report, and for something like the non-farm payroll, when I trade the euro dollar on the non-farm payrolls as it's the most volatile. You can do dollar yen as well if you want, but stick to the majors. And the reason I say that is because obviously at time of volatility you want the most liquid. You want to be trading the most liquid pairs. So something like non-farm payrolls has an average pips of around 140, 150 pips. So there's plenty of scope there to make money. Some of your news announcements won't have that kind of volatility, and you need to know that beforehand to help you plan your trade. Yeah. So for example, if we're trading CPI, the CPI is more of a 50, 60, 70 pip average move. You're not going to be, once you've sort of got the 40, 50 pips out of there, you know that this is pretty much the whole scope of the move on average. If you're trading obviously non-farm payrolls, you know it'll be slightly bigger. Trade balance, that's another one that comes out that's probably around 70 pips, 60 pips average, or maybe higher. An FOMC announcement, like a news conference or something like that, that could be have an average move of something like 50, 60 pips, assuming nothing completely surprising is said. And another one like retail sales, that's obviously quite an important one, particularly when we're trying to gauge inflation. That can give you again another nothing like NFP, but again you can definitely scalp 30, 40 pips out of that one, because it has an average pip move of around 70, 80, 90 pips. So obviously a big factor is the what you expect, the expectation, and then the actual news release. So obviously, if we are expecting, if we're waiting for an interest rate announcement, for example, and we're expecting half a percentage point increase, and we only get a quarter of a percentage point increase, you'll probably find that currency loses value. Which may seem strange, because an interest rate rise would usually imply that the currency strengthens. But you've got to remember that a lot of the trades have gone on before the announcement. So there is a expectation there from the market, and they have taken positions in accordance with that expectation. And when when an announcement is then lower than what was expected, obviously traders need to adjust their positions in accordance with that announcement. And in the example I've given, that would be the selling of that currency and liquidating some of those long positions in that currency, because the interest rate was not raised as high as was expected when those positions were first taken. And when you look at an economic calendar, you'll often find you have the expected number, which and then you have the actual number on the release date, and you show you two different columns. The expected number, where does that number come from? That number comes from various analysts that sort of forecast what the number should be, and these various analysts are interviewed, or a survey is taken, and it gives you an idea of what the sort of market view is, the consensus in the market, and you'll see that all displayed for you on an economic calendar. Yeah. So what you'll find is we have as I said earlier, you have an employment figure or whatever it is that's coming out, an economic announcement. Many of the positions are built up before the announcement comes, and then depending on what that announcement is, the market will move in the direction you would expect it to move. So if you have, for example, an announcement that says durable goods gone up hugely, yeah, positive number for the economy, implies inflation, implies future pressure on interest rates going up, which would then attract money to the country and to the currency, so you expect a stronger economy. Now, if we expected durable goods to go up anyway, then that position would have been taken in the days leading up to the economic announcement. So you may not find on the day that the currency goes up as you would expect. It might go slightly, in fact it might even go slightly down as some profit gets taken off the table. You might get a small move up, and then that fades out. So a lot of people turn away from fundamental analysis because of this, because they say, well, you know, such and such an announcement should have strengthened the US dollar, but instead it just sort of only moved up a little bit or moved sideways. So, you know, it's an unreliable way of trading. I usually find it's because the trader has not kept track of the economy and the things that are influencing the economy and the economy is sensitive to at this point in time. But let's look at news trading. So there's two ways we can look at it: from the perspective of fundamentals and understanding economics. If you're not someone who fundamentals and economics is plays a huge part in your trading, you can still trade the news technically, and I'll show you how to do that in a conservative way. It's on the basis of accepting that an important news event is going to give us a move in one direction or another, a large move in one direction or another, and we can technically get into this move just by looking at smaller time frames, waiting for the announcement to give us our bias. Yeah, so depending on which direction the market shifts after the announcement, that gives us our bias, and then we use small time frames to be able to get in to any pullback in that direction. So we'll look at that in just a moment. But first, I'd like everyone, if they can, to get an economic calendar up, and I want you to start highlighting economic events that are happening, and pick one economy, if you like, the US or the Japanese economy, and just look for start off by looking for just economic announcements for that economy, the ones that are important. Now usually you find on an economic calendar they will show you, they will give their opinion of what they think is low importance, medium importance, high importance. I don't always agree with those, so definitely look at the medium and high ones, not just the ones that are highlighted as high. And you want to highlight definitely the big important ones. So for example, monetary policy meeting minutes being announced, things like GDP, Housing market reports. You've got durable goods reports, CPI, as you've got there on the screen. Interest rate decisions from central banks like the ECB, if you're looking at Europe, and any interviews or speeches or news conferences from any of the ECB members. So these are the sort of things you want to know when they are going to be released. When is the FOMC meeting minutes being released, for example. And everyone should definitely have non-farm payrolls highlighted on their calendar, because that is a huge news event. Understand what all these different things mean. I mean, just generally, just so you have a good idea. For example, CPI we have here on the screen. What does that measure? And it's a form of measuring inflation, yeah, through what consumers spend on their day-to-day expenses. How is it calculated? Well, you get a basket of goods and services, yeah, which could be housing, clothing, food, energy, medicine, etc., etc. And the idea is it's trying to measure the cost of living. Yeah. Yeah. So pick an economy. Look at what growth is happening in that economy. So, for example, if you wanted to look at the European economy, you want to look at estimates for GDP, Q4 GDP, which were released a few days ago as unchanged. Things like net trade, which was not great. Yeah, we had a 1.5% increase in exports and a 2% increase in imports. So as for inflation, unchanged estimates for March. We had a slowdown in the year-on-year readings. Unemployment across the Eurozone was pretty much the same, slightly down from 9.6 to 9.5%, which, you know, is not a fantastic number, but it's, I think, the lowest number since 2009. So that's a step in the right direction. Slightly higher consumer spending, retail sales volume, slight increase as well, month on month. A big jump in non-food stores, textiles, clothing, footwear, things like that. And this was the main contributor to this annual increase. As for trade for the Eurozone, there was a surplus, but we've still the deficit in January is still dragging that quarterly number down. Yeah, unless we have a huge surplus for March. So obviously, if you're looking for a news trade there, a news event, you'll be looking at the March figure to gauge what will happen with Q1, this Q1 GDP in the Eurozone. Yeah, so we've got an improvement in the labour market. Yeah, higher retail sales, that makes sense, but then trade isn't too good unless we have a big number in March. Yeah, so you'll be looking at that number closely. And then if you were to trade that in March, you'll also be paying attention to the very good PMI figures, which may suggest that although we won't have a good Q1, things will still improve maybe in Q2. So you have, you know, on the whole, Eurozone economy looks okay. Individual countries such as Greece, terrible. And then you have other risks that are not going to be on the economic calendar, like, for example, a potential problem with the Italian banking system, or further problems with Greece, which, as everyone accepts, is never going to get out of the current mess they're in without substantial cuts to their debt. And not to mention, of course, the elections that are going on in France, where we have Marine Le Pen and Emmanuel Macron, who have emerged as the leaders to go into the second round, which many are predicting the majority of the electorate there in the second round will then not go with Le Pen. But as we had before, there is still a huge amount of risk there, because Brexit was not forecast. The polls did not forecast that, and the polls also did not forecast Donald Trump becoming the President of the United States. So do expect some volatility in the euro coming up to this election, regardless of what the polls are saying. But there is an example of how looking at the polls at the moment is a hugely important thing if you're looking at the euro, whereas looking at the polls in a few months' time or 6 months is not at all important. And that's why I said at the beginning of the webinar that I can't just say to you, look at this particular economic announcement or news event or anything, this is the important one. You do have your general core ones, like the ones we've discussed, interest rates, the jobless figures, obviously non-farm payrolls, huge one. But then you have announcements and news events like polls being released, which are not going to be important, in 6 months' time, whereas right now, hugely important, and people are looking at them and something that's going to really affect the euro. So it's important to understand what is going on in that economy, and then it'd be a lot easier for you to see why, for example, the polls are so important now. If you were not paying any attention to the French economy and European economy as a whole, you didn't know there was an election going on there. Of course, you wouldn't know to look at the polling data and when it comes out. But as I said earlier, perhaps you're not that involved with the economic side of things, the fundamental side of things. You can still trade these news announcements, and this is how we can do it technically and conservatively. Now, first things first, we need to be able to make sure we highlight on a chart. Let me zoom this in. We highlight on a chart the any support and resistance. And I mean major support or resistance you can see on a 4 hour, on a daily, weekly, as well as pivot points. I don't know if any of you guys use pivot points, but I certainly do. Just the basic pivot points. So anything on a daily, like an R2, if we're looking to the upside, or an S2 on the downside, or even an S1. We need to highlight these things, so we need to know where we are. So we need to sort of take a step back, look at the chart, and understand where the very strong contentious areas are. Yeah. So if price moves into that area, then we know that might be the end of the move. So we've got your weekly pivots there. You've got your daily pivots there as well. So once we've established these things, and we know where they are. So let's say, for example, let's start from the beginning. So this is what the market's doing. It's sort of going, it's making these small sort of moving candles. And then we get the non-farm payroll announcement, and boom. This is a 1 minute chart, by the way, guys. This is what I do when I get a news event. I drop into either a 5 minute chart or a 1 minute chart, and then I wait to see what the reaction of the market is after the announcement has occurred. Yeah. So I wait for the announcement to come out, and I do nothing. I sit there and I wait. I wait to see which direction the market wants to go, and this is an example of it. So in this example, the market is shot up, in a bullish direction. I have to be very aware of any, in this example, I want to be very aware of any resistance on the chart, so any major resistance. So for example, where my arrow is pointing here, if I've got, for example, here a daily R2 or a weekly R2 or something like that, even an M4, I want to be aware of these things, because that could be the end of the move. That could be where the market wants to die out. Yeah. So I want to be very aware of that. If it's here, for example, that's going to, I'm not going to be as confident in taking a long position. So we do nothing. Non-farm payrolls is announced. Boom, the market moves. It's moved up. Yeah, we've got 1, 2, 3 or so candles up. What does this tell me? Now this is if you're not looking at economics, guys, you're not following, it's not a core part of your trading fundamental analysis. You want to use charts to technically trade a news event like non-farm payroll, which is, many would say, an emotional event. A lot of these news events are emotionally driven. So we have this reaction, which is up. And immediately what you should say to yourself is, I am only allowed to buy. Yeah, this is the reaction, the initial reaction of the market, and I'm only allowed to buy. Now where can you buy? What I do is I pull a Fibonacci retracement of the move since the release of non-farm payrolls, or whatever the whatever it is whatever news event you're trading. You might be trading oil on a Wednesday, inventories. Yeah, every Wednesday that's released, and maybe you don't trade oil. Maybe you're trading the Canadian dollar because you're a currency trader. Yeah, you know when that's going to be released. You know the effect it has on the Canadian dollar. So you'll be trading the dollar CAD. So whatever the news event is, you wait for the announcement to be released. You wait for the reaction from the market. So in this case, in this example, up, and then when you start seeing the market pull back, yeah, that's when you draw your Fibonacci retracement. And what are you looking for? You're looking for price to come back to somewhere between the 382 and the 618. Yeah, 1 minute chart, 382 to 618. Now what? As soon as you've seen it come back, so in this example it's come back to roughly the 50%, as soon as you see any kind of green candle developing on this chart, you have to be very quick. There's no waiting around for confirmation or deciding what to do. You've done all that before the news was released. Yeah, before non-farm payrolls came out, you had made your decision already. You're going to wait for the market to tell you if you're going to be a bull or a bear. In this example, the market shot up after the announcement, so you're only allowed to buy. You're a bull. You wait for some kind of a pullback. You can see those two red candles there pulling back. You draw your Fibonacci retracement, and as soon as you're in that zone, 382 to 618 zone, you wait for any kind of green candle to start developing. Any sign of green. As soon as you see it, you've got to be quick. Press that buy button. Yeah. Something like this. Brilliant, that's good enough. You just want to see some hesitation, some confirmation that other people are looking to do what you want to do. There's your entry. Yeah, the candle then, if you wait around for this candle to develop, you're too late. You've come out of the area now, and you're inheriting a lot more risk than if you are here. Because if it goes wrong, you know you're going to get out if it goes either below the 786, yeah, where I put here stop, or maybe a lower low, depending on which, depending on the scenario. You can't have hard and fast rules here. You have to look at, what the chart looks like, how many pips things are away, what support levels you have there. But if you take the buy up here, waiting for this green candle because you're hesitating, and you only need to hesitate by a few seconds, guys, and it's all over. Then now you're risking a hell of a lot of money until you get to your stop, you see, because it can then fail here and come down. Right. So you need to get in this zone. And what happens a lot of the time, more often than not, is that will then extend to maybe a pivot point or to the Fibonacci extension. Now in this case we had a 50% pullback. I always look for an extension of something like a 1382 to a 1618 on a 50% pullback. I've done a whole webinar on Fibonacci, guys, so if it's not something you use, go back and and watch that webinar. So once you've bought here, if you are not profitable within, say, a minute or so, then there's a problem. Yeah? Sort of 5 minutes go by, 10 minutes go by, and it's still hovering down here, and not, you know, there's no, there hasn't been this reaction to the Fibonacci pullback. Then you've got a problem there. And because it's a news trade, guys, it's not something you need to wait around too much for. We've seen the move, we've seen the pullback. Either other traders are going to get onto that and extend it up, or they're not. And it's going to happen very quickly, very soon. As time goes by, 10 minutes have gone by, 15 minutes, 20 minutes, that news trade is getting colder and colder. Yeah, so first of all, we wait for the market to react to the news. Yeah, so don't be in a hurry then. Wait for the market to react to the news. Wait for some kind of a pullback. Draw the Fibonacci. Once you're in the area, anywhere between a 382, 618, you look for any kind of green, which will give you your entry. Yeah, you take that quickly, and hopefully the market extends, in which case you will take your profit at the extension. Yeah, or if you can see some kind of a major resistance level. Okay, and that's it. Now, if it fails, it will come up a little bit, perhaps come down and fail, and there's your stop down here. It's either a lower or below the 786, or it will just come straight through the fib and it will do a V-shaped retracement, which is not that common, but I mean, it can happen. Okay. It could happen because we have a revision of the last month's data that also comes out with this data. Various things which I'm not going to go into, because we're now looking at it from the perspective of someone who's trading news trades, technically, conservatively, but technically, and they don't use fundamentals as a huge part of their trading. Yeah, so if it's you don't follow the economic concepts behind a news report, then this is a very effective way to trade that news event, high risk news event, conservatively and effectively using charts. And this is an example from last month. So we have news announcement, market moves down. This is a 1 minute chart, guys. So you can only sell. Yeah, you are only going to sell. You wait for a pullback. If you get one, you then draw your Fibonacci. You look for anything in this area between the 382 and the 618 to go short. Yeah, as soon as you see a red candle, so that could be that one or this one, you just take a short, and that's it. You've done your job. There's nothing more you can do. Stop above the 786 or above a higher high if you want. 786 is fine because you do not expect this news trade to come all the way back. And if it does, perhaps it's just on a larger time frame trade. But as far as your news trade is concerned, this is something that should happen in a relatively short period of time. So you're short here and you're expecting an extension seeing as this is, well, I guess it's almost a 50%. It's between a 50% and a 382, so you're looking for a 1382. Didn't quite extend down there. It got to the 121.4. I haven't got it on this chart. Perhaps there's a pivot point here or some other level of strong support, as I spoke about earlier, and that's why you need to zoom out of that chart and be able to identify where those levels are before you zoom in and look at the 1 minute to scalp the news. This one is from March, so it's the March the 10th FOMC. Here we are, March the 10th. So this one, again, you have the market just doing this. You have the news announcement. It shoots up in this direction. There's nothing you can do. You sit there, you wait for that to come out. All this tells you is that you are only able to buy if it pulls back. And it may not pull back, or it may pull back and just come straight down here and go down that way. That's out of your control, guys. That's that's nothing you can control. What you can control is you will not buy or sell until you wait for the announcement to come out and see which direction the market reacts. In this case, it reacted in a bullish direction. You then start seeing a red candles coming back, retracement, so you draw your Fibonacci. Lines here, and as soon as you see any kind of green, which is in this case here, you buy, stop below the 786 or a lower low, whatever you prefer, and then you wait and see. In this case it comes a little bit lower to the 618 before it goes up, and you can see here that as this is a 618 pullback, your profit target or extension on a 618 would be a 1382. So assuming we haven't got any other serious levels of resistance here in the form of a pivot point or something like that, we can take our profit at the 1382. Obviously you want to see if what the range is in pips here, and compare that to the you know, whatever you're trading. In this case it's a non-farm payroll. You want to compare it to what the average pip move is on that particular news announcement, and make sure it's nothing wildly out of what you are what you're experiencing. Yeah. So in the case of non-farm payroll, this would be okay. If non-farm payroll was an economic announcement that only gave us, say, a 30 pip, 40, 50 pip average range, then obviously we wouldn't be targeting 150 pips or 100 pips in our trade plan. Yeah. So 618 pullback, the extension is a 1382, so that's 1382 there, so you would be taking your profit somewhere here at the latest. Let's see if I've got the April announcement, the February announcement rather, which was the 3rd of February. Okay, here we had price moving like this, then we had a wild move that sort of went up and down all within this 1 minute bar, eventually ended up here, giving us the go ahead to buy and be bulls, but we have to wait for a pullback, and then this could have just carried on. It did come back to here and then started going, and a lot of people would have jumped onto this now and made a huge mistake, seeing some green and thinking, oh, I'm going to miss it, it's going to just carry on and go up and I'm going to miss the trade. It's perfectly okay to miss the trade, guys. Yeah, you don't need to get on the trade, and the reason you can't get on it here is because it's far too risky. Even if this does succeed and go up, which yes, sometimes it will, your stop needs to be here, and that's just too much risk. That's not trading conservatively. Yeah, so that, I know some people will take that, and there's some people who are successful in trading this way. My advice, and the way I trade, that's a no-no. You do not buy this this fib pullback. This is a 5 EMA here. or a 21% pullback on the Fibonacci. You wait for a pullback into this zone here, 3822618. If it doesn't happen, it doesn't happen. Never mind. Next month, have a look at non-farms again. If it does happen, it gives you the opportunity. Comes down here. As soon as you see some green, this candle here, you buy. Stop below the 786. And that's it, your job is done. It's either going to come out and take you out for a small loss, or it will extend up and you will take a profit. Okay, and that's the conservative way that I trade non-farm payroll and other news events. Conservatively, managing your risk, guys, because you're not going to get it right all the time. You don't want to take huge losses on these news trades. You want to trade them conservatively. Avoid this. This is not something you buy. Let me see if I can give you just one more example. This is January the 6th, I think. Yeah. So again, we have price. Okay, we have the announcement, which is obvious. It's this huge candle again. Flies both north and south, ends up coming south. More red candles, which say to us, right, we can only sell if it gives us an opportunity. If it comes back and gives us an opportunity to sell, we can sell. It starts coming back. We see these are 1 minute candles, green candles. You draw your fib. Okay. There's your 382 to 618. You're looking for anything in this area. As soon as it comes back to this area and you see some red, you take the short, stop above the 786, and that's your non-farm payrolls for January the 6th. Now you're not going to hold this trade out, guys. You're not going to wait hours on end to get your, the trade, as time goes on, this trade is becoming less and less, the movement in the market is becoming less about this news trade. Yeah. So a lot of people would have got out of there after half an hour, or definitely after an hour. Okay. News trades tend to not go on for 5 or 6 hours. That's the top of the fib. I've drawn it because it's the top of this candle, which was the initial move. Whereas if I put it here, you wouldn't be able to see it. For the person who asked that question. And then the month before this, that was the December NFP. Now remember that the December NFP, actually I remember it, and this is for those of you who do have fundamentals as a larger has a larger impact on your trading. The December NFP, I remember the number was pretty average. It wasn't going to make any huge difference to certainly not to the central banking policy. So I remember what I did was, and even though the market moved in one direction, and I did initially draw the fib, I didn't end up trading simply because I just didn't expect that number was actually going to make much of a we were going to get much of a follow through. And what I did is I had I didn't look at the euro. I took the euro down and I put up a dollar CAD chart, simply because Canada had a better than expected jobs number. The US had a worse than expected jobs number, and so I felt that that currency pair would perhaps give me a little bit more of a move than say the euro dollar, which is what I would usually trade for non-farm payrolls. So that's just an example, guys, of how, when you're following different economies and you're in touch with the fundamental side of of trading, you can it can help you pick which chart you'd have a better chance of trading in that particular moment. Now, on that particular day, as I said, I didn't even take the trade in the end because I just felt that things were just too slow. There wasn't much of a volatility. Having said that, you can just take the trade regardless. I probably should have just taken it anyway. It didn't go anywhere. It just went up a bit sideways. There was nothing to be made. But the point is, it's just a trade. You're only really risking 25 pips anyway. 30 pips maybe, you know, if you're going to have a stop at a higher high. You're never really risking anything much more than that. So it's just a news trade. It's nothing major. It shouldn't really have a huge impact on your month or you know, your year or anything like that. Or it's just a news trade. It's a very small trade in comparison to all the other many trades that you should be taking throughout the month. So there shouldn't be that much stress or you know, huge analysis that needs to go into this one relatively small trade where you're not risking a lot. Yeah. So the idea is, you know, that you're taking a trade at something which you can reasonably say, in this case it would be, you can reasonably say that this is resistance, can you not? Market has broken down here, it's pulled back. If you're looking to short, anywhere in this sort of price zone would be a reasonable, I mean, most traders would look at that and say, well, that is actually going to form perhaps some kind of resistance. Trade responsibly, guys, and take care. All the best.